Welcome back, traders. Rober is here. Today I have a short trade technique for you. This technique is called ORB, or Opening Range Breakout. Let's meet this technique. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. ORB is a scalping trade technique. Mainly, we will focus when the market opens. During the opening of the market, there will be a very high volatility. And most of us will use this technique with the stock market at the time of New York. The stock market we use will be New York Stock Exchange, or NASDAQ. During the opening of the New York market, it will be the closing of the London market. Therefore, it will be a period of time when the market is stagnant and very volatile. When the price is very volatile, there is a chance to make a lot of profit. The graph will be like this. Suppose I have a line. This line divides yesterday's time and today's time. When the market opens, we will determine the period or range. This range is called the opening range. After we finish the period, we will consider that during this period, we will do the job like a channel. There is a bottom line and a bottom line at the top. The price has the opportunity to bounce back and forth around this channel. And the point that we are interested in entering the trade is the point where it breaks out or breaks through the bottom line. Next, you may have a question about the opening range. How much time do we use to schedule? Most investors will use the period at which the market is tense for only the first 15 minutes of each day. If it is a New York market, it will be from 9:3 a.m. to 9:45 a.m. There are many reasons why the market is tense at this time. It may be an order that has been held since the market closed, or in the past night, it has been reported by the economy. And another factor that cannot be overlooked is that the big price fluctuates in the first period of the day. I have an example for you to see. It is the opening of the market for 4 days. These 4 days will use the graph for 5 minutes. Therefore, when the market opens for the first 15 minutes, it will be equal to 3 bars. On the left-hand side, you will see that when the market opens, the first 3 bars have a lot of volatility. The price has dropped sharply. We can mark this range as it is. The second day is still the same. When it opens, there is a gap up. When it opens, the price goes down within 15 minutes. We also got a range. On the third day, we will go back. When the market opens, it will open low. But when it opens, the price will create a range in the positive direction. We also got another range. Finally, the market opens low and rises as well. We also got a range. These 4 examples, you will see that the price is very volatile in the first 15 minutes. After that, the price may bounce or break out. The important key of this technique is that we will not trade in the first 15 minutes. We are not sure what will happen in that period. The price may fluctuate, or it may be a fight between the financial institutions. Therefore, we will wait for the price to start steady and then find the time to enter the trade. Our setup will be divided into 3 steps. It may look a bit too much, but when trading, friends can do it quickly and find the time to enter the trade easily. The first step, we will look at the market trend in the overall picture first. This step we will use at the time frame of 15 minutes. We will see that the market is up or down. After that, we will look at the trend in the past. Most of us will look back 2 to 3 days. And finally, we will determine the range of the first bar or when it passes 15 minutes after the market opens. The method is according to this graph. The time frame is 15 minutes. Let's divide the day. For example, I have the day before and yesterday compared to today for you to see. Now it's 9:3 p.m. The market is just starting to open. We will look at the trend of the day before and look at the important trend. For example, on the day before, the price has risen, then the long sideways. Therefore, it is an important resistance. After a while, the price went up and went down again, but did not go further. Therefore, this area is also a resistance. In general, the old resistance has now turned into a resistance. We can mark the position. In addition, if you look at the high position of the previous day, the price rises and bounces down, there is a small trend. After a while, when the new day begins, this trend has become a trend. The price rises and rises. The moment it rises, it comes back to test at the same trend, which is now turned into a trend. We can draw another line. At the end of yesterday, half a day in the morning, the price was sideways. The price will go up or not. After half a day in the afternoon, the price went up and then went back up. When it went up, it was a fixed trend. Therefore, the original trend has now become a fixed trend. We got the key level out. After that, we will determine the range of the first bar. After 15 minutes, now it's 9:03 a.m. The market has just opened. Wait for 15 minutes. The price has risen dramatically. It has turned into 9:45 a.m. Therefore, we can determine the range at the first stop. This range will be measured from the high point to the low point. We call it opening range. And the upper side of the range and the lower side, we will call opening range high and opening range low. Use the symbol ORH and ORL. The next step, the second step, we will check that the range we just drew, is it big enough? If the size is big enough, it means that the market is very competitive. The big line may leave a mark so that we can trade with it. We will go back to the one-day time frame. We will check the range of the stock in the first step to see how big it is compared to yesterday's ATR. If you remember, ATR tells the market performance. We have to look at how much today's trading performance is compared to yesterday. And to get through today's gain, there must be more than 1.4% of ATR gain yesterday. Let's take a look at the example to make it easier to see. This example is the range that we have specified in the first step. We will check whether the range of this tank is large enough. If it is large enough, it may be the price of the large line itself. In this example, the range of the first tank is about $5. After that, we will go back to the ATR of yesterday. I will show you the graph on the left. This graph is a one-day time frame. Therefore, each column is the price movement yesterday and the day before. At the bottom is the ATR that measures the price fluctuation. We will focus on yesterday's column. This column, we will look at the ATR. We will read its value, which when we read it, we got a price of about $6. At this point, we almost don't have to check anymore. The first range of today is $5. Very profitable, similar to the price movement yesterday. Therefore, today's opening range will actually pass the gain. But for you to see the picture, let me calculate a little bit. Yesterday's ATR was blue, about $6. 25% of ATR, or 1 in 4, is about $1.5. Our gain said that today's opening range will be wider than 25% of ATR. After comparing, we will find that $5 is more than $1.5. Therefore, today's yellow has more value than yesterday's blue. It is considered that through gain, we can find the time to enter the trade in the third step. The third step is to enter the entry and exit the trade. The time frame will change to 5 minutes, and we will try to enter the trade within the first 2 hours of the day. The market opened at 9:3 the first 15 minutes. After that, we will wait until 11:3 to enter the trade. For the original opening range breakout, they will trade only breakout. But I have divided this technique into 3 types. 3 types will have a normal breakout, a breakout, and pullback. We also have a reverse or return price. For this clip, we will focus on the breakout only. For the next clip, the second one will be a pullback trade and a reverse trade. Let's take a look at the graph. Entry and exit, the first one or the breakout. The first step, we have a blue bar, right? This bar is the bar that opens at 9.3 to 9.45. We will get a range. After that, we will change the time frame to 5 minutes. After changing, bar 1 will become bar 3. 5 minutes per bar, 3 bars is 15 minutes. And we will wait for the time. Wait for the price to bounce back and forth until it breaks through the range. The moment it breaks through, we will find the moment to enter the trade. The second pattern, the pullback technique, the idea is the same. We got the range first, change the time frame. After that, we wait for the price to break out. When the price breaks out at this point, we will not enter the trade. We will wait for the price to pull back and test the resistance. The old resistance is now a resistance. we can find the time to enter the trade. The last pattern is a reverse trade or a return trade. At first, when the market opened, it was a big green bar. The price really broke out. But it's a fake breakout. The price goes up and down. Therefore, we can find the opening time after the fall breakout. Today, I have 4 examples for you to see. These 4 examples will be a model of a single breakout trade. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. Let's meet the first example. First, I will mark the day before to compare to see 3 days in a row. There was a day before, yesterday and today when the market was opening. If you look at the trend, we will see that the past 2 to 3 days, there was a trend of the market to rise. After that, when the market opened for 15 minutes, we got a red dot, 1 dot. This dot, we will determine the range from the top to the bottom. After we have determined, we will check the 25% ATR gain, which, all 4 examples, I have checked the gain, and it passed the gain. Therefore, I will not show the time when we check the gain. After checking, we will change the time frame to 5 minutes. From 1 bar, it will turn into 3 bars like this. Once we get the range, we will drag the edge to the length of 11.3. During this 2 hours, we will find the time to enter the breakout trade. Because this example is an upward market, we will trade only on the buy side. Wait for the breakout to occur in the next week, which is enough to wait for the price to come out like this. Below, you will see that the price has gone down, but we don't count. We don't set it to be a breakout. We will count when the price closes outside the range. As for the upper side, it is not set to be a breakout either, because the price has not yet closed the upper range. We have to wait. Wait a little longer, the price will break out. When it breaks out, it closes the upper range, which is considered through the gain. This bar I call the first bar. We will not buy immediately. We will wait for another bar to turn green as well. When there are 2 green bars, we can find the time to buy. The reason why there must be 2 bars is because there are many times that the first bar breaks out, but when it is the second bar, it goes back down immediately. If we buy at the first bar, there is a chance to lose money when the price goes down in the second bar. But in this example, there are 2 green bars attached to each other. We can place a buy. Next, we will place a stop loss. Our stop loss will be at the top range or opening range high. After we get a stop loss, we will place a TP with at least 2 to 1 RR. TP will be like this, which is quite far. Once we enter the order, we just wait for the price to go up until it hits TP. We sell it out and get 1 profit. The next example is still a market. I want to divide the day into 3 days as before. The day before, at first, the price went down and rebounded back up. As for yesterday, the price hesitated to go up. Decided to be sideways. Therefore, we try to find the trend of yesterday and the day before. Take it as a reference point, which in this place, we look at the high side first. Yesterday and yesterday, the price tried to go up but couldn't go up. Therefore, this area is decided to be an important trend, may have an effect, according to today's price movement. And when it's been 15 minutes, 9:45 a.m., we got 1 red diamond. This diamond is set to range as before and check to see if it's big enough. After checking through the gain, we change the time frame to 5 minutes. As before, from 1 red diamond, now it is turned into 3 bars. At this point, there is an important resistance from the 1 5-minute time frame that we set at the beginning. And we will set the time to enter the trade at 11.3. Don't forget, because in the previous day, there was an uptrend in the milk market, and yesterday it was not decided. Therefore, in the overall picture, it is still up. We will enter the trade on the buy side only. Next, we will wait for the breakout to occur in the week. In this example, just wait 10 minutes. The price has risen to the first bar. We will not buy yet. We will buy when the next bar is green, which is the second bar here. The second tank is very important because the price is important. Therefore, the price has a chance to break out and go up for a long time. We will buy according to the system when the second tank is over. I bought it as before. Set the stop loss at the top range, which is this zone. After we get the stop loss, we will set the take profit to have at least 2 to 1. At this point, it will be like this. After that, we wait for the price to go up to TP. This example has an interesting point. The price does not go up immediately, but the pullback returns to the important trend. Now the trend is doing the job as a trend, and the price goes up to our TP. Then we sell it for profit as before. The third example will be the fall. We're at the time frame of 15 minutes. Divide the day into 3 days, as before yesterday and today, when the market opened. Looking at the trend, we found that it was a downward trend, and most importantly, there is one trend. This point is the trend of both the day before and yesterday. Therefore, it is an important trend to keep an eye on. After 15 minutes, the market opened. There was a lot of speculation. There was a fight between buyers and sellers. The price is only a long skyline, both above and below. We do the same step and set the range in the first 15 minutes. Don't forget, we have to check the gain first so that it passes the ATR gain. After passing, we will change the time frame to a smaller time frame. After changing, the appearance will be like this. Don't forget, we have an important trend, not close, not far. After that, we set the time to enter the trade until 11:03 a.m. As usual. A little more. Because it is a market, we will trade only on the sell side. We will wait for the price to break out in the trend and then enter the trade. Which, just wait a minute. Within 5 minutes, the price will break out. It is the first bar. We will open a short or trade on the sell side. When the 2 red bars are connected, the second bar is also red. Therefore, through the gain, and most importantly, it also reflects the trend. Therefore, we can open the shot comfortably at this position. After opening, we set the stop loss at the lower range or opening range low, which is a little bit far in this place, but for safety, we have to set it according to the system. Finally, we will set take profit at least 2 to 1, which in this place, it will be removed. Once we get take profit, we will wait for the price to go down until it reaches take profit. This example has a little hesitation to pull back, but in the end, it goes down for a long time and gets profit as well. The last example for this clip is a down market in the 1-5 minute time frame. Divide the day to see the trend first. It is clear that it is a down market from the day before until yesterday. After we get the trend, we wait for the market to fight before the first 15 minutes, 9.45. We mark the position to get our range. After that, we will check the gain that it is enough for trading today. After checking, we will change the time frame to 5 minutes. From a large red bar, after changing, it becomes a 3 bars bar. We set the time to enter the trade at 11.3 as before. After that, we will wait for the price to break out in the week, which in this case, the price breaks out immediately, but it's not as intense as the previous example. It's okay. Our system, number 1, at the breakout, we will wait to open the shot. When it is a red diamond, 2 diamonds are stuck together. The second diamond is really stuck together, so we can find the time to open the shot, which is around here. Our stop loss, if it is the same system, will have to open the bottom of the range. But because it is close to the point where we open the shot too much, therefore we will move our stop loss to be farther than before. In this place, we will use the high of the second bar, which is this bar that we open the shot. When we get the stop loss, we will prepare to take profit. Take profit as before, at least 2 to 1. In this place, because of stop loss, it's short. Take profit is not far away. From the example that I see with my eyes, it should be RR 3 to 1. After everything is done, we wait for the price to go down to TP. This example has already made a profit at 3 to 1, but if friends set it further, there is also a chance to make a profit. In conclusion, opening range breakout is a formula for using one trade when the market opens. In the first 15 minutes, we set the range to enter the trade, but not yet trade. Wait a while for the price to calm down. Once the price is calm, we will enter the trade back breakout according to the trend of the past day. For the next clip, I will take you to see a pullback trade and a reverse trade. Don't miss it. Stay tuned to our YouTube channel for today. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you.